What is going on, everyone? Welcome to our Finance Tuesdays. We are on part two of the Blueprint to Financial Freedom. Last week, we talked about understanding money and the importance of exchanging money and how it all works because it's a medium of exchange. And we just wanted to build that foundation so we can understand that money is a tool and that we have to exchange it properly, because if we're exchanging it to the wrong systems, it's only going to hurt us, right? And we got a little bit into about the bank. And again, we're going to get deeper into these topics down the road. But today we're going to talk about the debt buyout, the debt buyout. And, in our society, debt is just everywhere. You see it with car payments, you see it with credit cards, you see it with just borrow this, borrow that, right? And the problem is we become slaves to these lenders, right? We never become free. We just trade our time away and our energy away, because if you think about it, when you're in debt and you're trying to pay this stuff off, well, you got to work more, right? You got to work harder, and you have to remain disciplined because it's going to take some time away from doing other things. Maybe you want to go out with friends or family. Maybe you want to go on these vacations. But the thing is, you got to deal with that debt, and it's not going to go away anytime soon. So we have to understand that debt itself is a symptom. It's a behavior we have to unlearn, and we have to learn to stay away from consumer debt, because consumer debt is just going to keep us trapped. It's going to keep us chained, and it's never going to help us in the long run. So let's look at this term called the time value of money. I'm going to pull it up for you guys on my screen. So here's what it means. The time value of money assumes a dollar in the present is worth more than a dollar in the future because of things such as inflation and interest rates. Now, if our dollar holds the same value in the future, then it's really not going to help us, because we want to grow. We want to get better, because we know with inflation, with interest rates, the value of that dollar is going down. The power of it is going down because of these prices. So we have to get ahead of this game. We have to make sure that we change course. And if we got debt, that's not helping us, right? Because you're paying interest on it. We're making payments on a monthly basis, and we're not saving or keeping enough for ourselves because all this money is going out to other institutions. So how do we reverse course? Well, let me give you my personal story first. I've paid off $16,000 of debt, and all that money I regained. You're like, how are you doing this? I thought when I use the bank, I don't see that money again. Well, I'm not using the bank. So we're going to get into that in a moment. So that's what I've been doing. I've been making payments on my debts, my minimum payments. I've been putting it somewhere where it grows at 3 to 5% on an annual basis. And when I borrow, that money continues to grow. It's been incredible. So we have to understand that if we're going to make sure we regain our capital, well, we have to understand where we put our money. It's so important. Yes, we got to keep our money, but we also have to put it in the right places. So here's what I do. I use life insurance. I use a dividend paying whole life insurance policy. So I started this back in 2020, and I was putting anywhere between 200 to 300 a month. And what I did was I put the money away. I made minimum payments on my debt. And when I had enough to borrow to go after my first debt, I did that. And the minimum payment I was making on that debt, I just paid myself back. So let me show you the chart and what this looks like. So let me go ahead and actually show you the steps first. So here's what you do. First, you fund a sacred account. Then you line up your smallest to highest debts, like Dave Ramsey says. You pay the minimum payment on each debt. You don't overfund or overpay a debt. You just make the minimum payment. You save up enough in your sacred account so you can pay off the smallest debt. And then you're going to borrow against the sacred account to pay off that first debt. And that freed up payment, you're going to pay yourself back. And you're going to rinse and repeat until all your debt is gone, all your consumer debt. And what happens is at the end of this, you still have that capital growing. It's still growing at 3 to 5%, because when you borrow money from the life insurance, it doesn't leave the account. When you borrow from the bank, guess what? It's gone forever, right? Also with the bank, you're making what, 0.1% on your money. So again, if you're fighting inflation and you're fighting interest rates, well, 0.1% isn't going to do you good for the next 5 years. If you're making 3 to 5% on your life insurance policy, well, that's going to do something, it's going to help you out in the future. So you want to put your money in the right places. You want to make sure that it's in a place where you can do more with it. And now what I love about life insurance is I have control of my capital. I don't have to worry about losing that money again. And when I'm working, I'm putting money in the account, it's there for good. It's not going to go away. Of course, unless I close the account or I stop making payments. But as long as I'm making payments, as long as I'm taking care of it and I'm building it, it's going to benefit me in the long run. So let me show you what this looks like. So let me go ahead and just show you on this document here. So let's just say you have $20,000 in your sacred account. You got $20,000 in the bank. You're making your minimum payment towards your car of $337, and your loan is $8,000 left. So let's say there's $8,000 left. You want to borrow from your sacred account. Guess how much is still in the sacred account? 20,000. Let's say you do it from the checking account. $8,000. Guess what's left? 12,000. So yeah, you can pay your debt back in the bank, but you're never going to see that $8,000 again. I'm going to my sacred account in the future. That's what's great. That's what's amazing. I am regaining my capital in the future. So the benefits of putting your money away in a sacred account is, one, I am protecting myself from emergencies, because if you have an emergency happen and you're saving on a month-to-month basis, guess what? You've got capital available to take care of that. You regain the capital if you're paying off your debt. So those are some amazing benefits. I'm also protected from taxes, because you're not going to get taxed on this money. And I'm earning a 3 to 5% dividends on an annual basis. Those are the benefits of putting your money in a life insurance policy. Now, you're probably wondering why you haven't heard of this before. Well, the reason why is agents don't get paid a lot when they write the policy this way. They make a lot less money when they set up that benefits the customer. So you want to find an agency who actually is on your side and who would do it correctly. Because when you have your policies designed this way, you're in control. You have the advantage. And if you use it correctly, because you got to use it right. If you don't use it the right way, then it's not going to work out right. It's like a car. Like if you don't drive it correctly, well, you're going to get in an accident. You're going to mess something up with your car. If you don't take care of it, then it's just going to not be functional anymore. So when it comes to this structure of the debt buyout, well, what happens is when you are regaining your capital, you now have money available to go use to invest. That's the beauty of this. If I use the bank and I pay off $50,000 of my debt, well, that $50,000 is gone forever. And guess what? If I have an emergency that happens, what am I going to do? I'm going to go back and have to borrow again. I'm back to square one. So that's what I love about this setup is I'm earning dividends, I'm getting more out of my money, and at the same time, it's growing for the future. Okay, again, the time value of money. So when it comes to our debt, we're now in control, right? We have peace of mind because, again, if you have enough in savings in the policy and something goes down, God forbid you have an emergency, well, you can just borrow from your policy. It might not be an ideal situation, but at least you have that available. So that's why it's so important to have a forced savings plan and save as much as possible. So you have the capital to take care of things. You have the capital to take care of your debt. And eventually you're going to be able to invest that same capital in the future. So I hope this changes your perspective and really helps you out. If you got any questions, leave a comment in the comment section. Make sure you like and subscribe to the channel. And also, if you want to check out my other videos on the Sacred account, make sure you go check that out. And I'll see you in the next video.